up, traders? Welcome back to the channel. Here we have the Australian dollar versus the USD, right? So the Australian dollar versus the American dollar, AUD USD. And I'm going to be going over a very simple outlook as to how you can determine a higher time frame bias on any US pair, right? Or any pair in general. So what we have over here is important to understand if we quickly go away from the charts. When we analyze and we create a bias, right? When we create a bias, there's four things that we need to look for when we're creating a bias, right? So these four things are as follows, right? And this is something that I go over a lot within the community, right? To help people understand how to create a bias. The first thing we need to understand is our market structure. The second thing we need to understand is our dealing range. The third thing we need to understand is the premium and discount arrays. And the fourth thing that we should understand is where the fair value gaps and the inefficiencies are. Whenever you are targeting or whenever you are trying to build a narrative with any market, these are the four key ingredients or the four key pillars that you should adopt when looking at any market to determine an overall higher time frame bias. And here's how we do that on the charts. So here we have the AUD against the USD. So what we have over here is we had bullish structure over here. So if I quickly mark out the structure, what we had over here is we had a structural high just over here. So this is our structural high, which I'll label in black. Daily time frame structure from all my videos I label in black. So what we have here is we have a structural high, and then we have a slight retracement over here. We have a structural low. Then from here we have a structural high up here, and then we have a structural low down here. Then from structural low we have a structural high right up here. Now from here, this is the first thing to understand. So we have bullish structure over here that then gave us a bearish switch just over here. So again, this is the last structural high for this particular range we're dealing with, and this here gave us a structural break. Now something to bear in mind is that this here was not a structural break. This was a wick sweep. This here was a break of structure with a body. So this is the first thing to understand. This is not a boss. This is not a boss. This is a boss. This is the true break of structure to the upside, to the downside. This is the true break of structure because we've broken with a body. So now that we've established that, now we follow the same exact principles again, right? Looking at our overall bearish structure in the market. So what we have over here, again, just to speed things up, we have a structural low, we have a structural high. We have a structural low, structural high, structural low. Now we've had a break of structure, we've had a bullish break, we've had a low, we've had another bullish break, followed by a bearish break. Okay, so we understand overall the trend, the overall market narrative is bearish. So now if we continue here marking out our structure, again, this is very important to understand. From here, again, to highlight this here was a break of structure to the upside. So we had a higher, we had a low, we had a high all the way up here. So this is the high. So this high over here produced a low all the way down here. So this high gave us a structural low down here. So this high gave rise to a structural low, structural high, structural low, structural high, and we have a structural low down here. So this now gives us our overall structural dealing range. Okay, now a quick thing to bear in mind that people should understand is that again over here, this is our structural high to the left. We need to understand that this over here is not a break of structure right over here, and the reason why this is not a break of structure is because we haven't had a strong close. We haven't actually closed above the old high. So the old high is resting in this region over here, right? So if I just clear this up, so the old high is resting just over here where I've marked out, and this here is a sweep of liquidity. And the reason why this is a sweep of liquidity is because we haven't had a strong close. So this here is a sweep of liquidity, right? Sweep of liquidity right here. So with that being said, we have a dealing range to work with. So now that we've been through our structure, so if we quickly get out the four rules, the four pillars again, we've identified our market structure. So this here gives us a clear market structure to work with. The next thing we need to identify and analyze is the dealing range. And what is the dealing range? What do we mean by the dealing range? And so the dealing range coincides with structure, right? So the dealing range gives us the most recent structural high and low. So we understand over here that we have the most recent structural high over here and the most recent structural low over here. Everything else is internal, right? We've gone in a massive range. Everything else is internal. So our dealing range, or our most recent high and low, stems from this particular region over here, right? So this here is a structural high, and this here is our structural low, just like this. This is our dealing range. And so this here, I'm going to label this in red because it's a bearish dealing range. This is a bearish dealing range. So again, what we've had over here is we've had two breaks of structure to the downside. So we've had a boss over here, and we've had a boss over here, right? So this is our dealing range, our bearish dealing range. So once we've identified our structure and once we've identified our dealing range, the next thing we want to look for is the concept of PD arrays. And so what do we mean by PD arrays, right? What do we mean by PD arrays? So in order to project and to use the Fibonacci tool correctly, right, we simply use the dealing range and we project the Fibonacci tool from the swing high down to the swing low, just like this. So we project the Fibonacci tool from the swing low, from the swing high down to the swing low from this particular dealing range over here. And so from here we get two distinct regions, right? So the middle line over here represents the equilibrium. So this here represents the equilibrium or the EQ. And we know intuitively anything above the equilibrium is a premium, anything below is a discount. So the last and the final thing we need to identify, and this is probably the most important thing when it comes to determining a bias, is looking for where the inefficiencies are or where the fair value gaps are. Because we understand the interbank price delivery algorithm, if I quickly bring your attention downwards. The interbank price delivery algorithm, known as IPDA, seeks different things in the market, seeks a few different things. The first of them being liquidity. The second of them being inefficiencies and fair value gaps. The third thing being it seeks a premium or a discount array respective to the price. So what do I mean by that? Simply put, if we're in a discount, price wants to seek a premium. If we're in the premium, price then wants to seek a discount. And this is the same logic that we apply here to the market itself. Once we've gone through our four main pillars of marking out a chart, right? Structure, dealing range, PD arrays, and fair value gaps. And now from here we apply the rules of IPDA, right? Simultaneously. So we're meshing these two things together. So now from here, our job is to identify any fair value gaps that lie in the premium and the discount. And how do we do that? Well, we understand, let's go all the way up to deep premium. So if we go all the way up to deep premium, we have a fair value gap over here. And a fair value gap gives rise to a POI, just like this, right? So this here is a POI. And the reason why this is a POI is because it's broken structure. Because remember, we're bearish overall. It's broken structure over here, major structure. It's well above the equilibrium. So we're in a very firm premium. We're in a very firm premium, and it's left a fair value gap and an inefficiency over here. So it's left a fair value gap also. An extra confluence for those who have a good key eye on liquidity. We have this over here. This is an inducement. This is a structural high that's been engineered by the market in line with the fair value gap just below the POI. And so this is an inducement. So my last video on inducement, I recommend people checking out as well. This is a form of inducement, right? This is a form of inducement, liquidity drop just before a POI. And so from here, if we drag the daily POI to the right, we understand that this is an overall target based off what we understand of liquidity and POIs and structure, etc., etc. So now the same concept applies. So we're looking for POIs above the 50% level. So we understand that we had an imbalance over here, we had some imbalance over here, but these have been filled over here, and as you can see, price melted down. So now we're still looking for POIs. Again, we had a fair value gap over here. Price filled the inefficiencies over here and headed lower. So what we're looking for is we're looking for areas of inefficiency. And now I've pointed at one to the screen over here, right? So this here is an inefficiency. So this here would mark our POI or our fair value gap. So this is our daily POI. And simply put, we understand that we project it to the right. And the reason why this is a POI is because we have a fair value gap over here. So this is an FVG or a sell side inefficiency in the markets, okay? Now, with this being said, now that we have our daily POI over here marked out, we need to understand we do the same thing in the discount. So when we're in the discount, we look for areas of inefficiency, right? And there's only one area of inefficiency, just to speed things up for this video. There's only one area of inefficiency that has actually been filled, and it's right here on the left of your screen. This here was the fair value gap over here, which I'm going to label in blue. So this here was the fair value gap, and so this gave rise to a bullish POI. So if I label that back in gray, what you need to understand as an analyst is that this particular POI is a counter trend POI, and notice how price came in just with a wick. So this is what we use to determine a bias, right? So we've been through the concept of structure, PD arrays, fair value gaps, and dealing ranges. We're now in the discounted range. So just to bring people's attention, this 50% level over here, it's a bit faint, so I'll mark it out here. This is the 50% level. This is the equilibrium just over here. This is the equilibrium. So we understand that we need to be buying from discount. Discount is below the equilibrium. We want to be buying from discount to premium. So the way we build our narrative is quite simple. we're looking to buy from premium all the way up to discount, right? So we're looking for a move like this, just like this. So overall, the narrative of price is to reach this next overall daily POI, and that daily POI stands at 0.677, right? So the people looking for some kind of a signal, here you go, 0.677, right? The exact price of it, 0.6779, just to give people an clarity, right? So this is the overall next target for the AUD USD, or the Australian dollar against the US dollar, right? The American dollar. And that's simply from using the basic concepts that we've been through in this video. So we understand that there's four main things we use to determine an overall bias, be it structure, then dealing range, then PDAs, and fair value gaps. So I recommend pausing the video and actually writing this down in your notepads, writing this down in your iPad, whatever it is you use to take notes. These are the four fundamental pillars to determining a bias or a higher time frame narrative in any market you choose to look at. Very, very important. And once you understand that, you then need to have an intrinsic understanding of what the markets actually seek for in the first place, right? The interbank price delivery algorithm, IPDA, liquidity, fair value gaps, and premium and discount, right? Price will seek liquidity, price will look to fill fair value gaps, and price will look to move from a discount to a premium. And we can apply this directly on live price action here on the AUD USD. We are below the 50% level, meaning we're in a discount over here. This is a discounted POI, right? Price has swept liquidity over here, right? An extra concept, right? Price has swept buy-side liquidity in the form of a massive trend line over here. So price came in. This is not an accident, everyone. When we see price sweep buy-side liquidity quite aggressively in this way as well, we see price come in. We've swept liquidity. So we understand IPDA has taken the liquidity. IPDA has filled the inefficiency in the discount, and now we're headed towards a premium. So in this premium, we have a daily POI, again, the fair value gap over here. So we have a fair value gap that needs filling. So there's an inefficient price action that we need, that price will look to fill at some point. We understand that we have liquidity resting just above over here. So we have a weak high over here. Remember, anything above highs and lows is liquidity. So we have a liquidity pool to target over here. We have fair value gaps to target over here. And we have a premium POI, premium daily POI to target over here. So whenever you're determining a bias, understand these main concepts when it comes to understanding price action as a whole. And you can't really go wrong, whether it's Forex, cryptos, futures, or anything else you want to trade. Understand these concepts is what's going to allow you to take your trading and your accuracy to the next level.